Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day. City roads and parking lots are brimming with new cars vying for space, and more are rolling out of showrooms as we speak. With a bumpy patch of pandemic behind it, India's auto sector is all set to surprise. Some experts say that this year's passenger vehicle sales may be 250,000 more than the initial estimates. The sharp uptick in August sales also points towards it. In our next report, we offer a peek into this auto boom and ask how long will this party last?
As the pandemic has ebbed and the supply of semiconductors has greatly improved, the production and sale of passenger vehicles has hit the fast lane in India, and it rose to new levels this August, year on year. Led by SUVs, PV sales may continue their strong performance in the festive season. Monthly sales data released last week showed that dispatches at the top 7 passenger vehicle makers rose 30.2% year on year to 3,05,744 units from 2,34,743 units. With the exception of May, when the growth came on the back of a low base effect, this was the sharpest year-on-year growth witnessed in FY23. Note that auto firms count dispatches to dealers as sales. Shashank Srivastava, the executive director, sales at Maruti Suzuki, expects the industry to end FY23 with a record 3.7 million units, which would be almost 21% more than FY22. Clearly, the sector is in the middle of a passenger vehicle sales boom that is likely to continue in the coming months. Maruti's August dispatches in India grew 30% over the corresponding month a year ago. According to Srivastava, the growth trend appeared to be strong, but performance going forward would be decided by how production pans out against underlying demand. He cautioned that while the chip shortage situation had eased considerably, some uncertainties still existed, particularly for specific models. Up to last week, the pending bookings at Maruti Suzuki stood at 3,77,500 units. But the real question is how long can the sector expect this party to last?
I think August has been an outstanding month. And this is in spite of the fact, that if we see globally, the markets are down, roughly 7%, whereas, India as a market in this year has been up by roughly around 16%, typically cars. It's primarily on account of pent-up demand. Obviously that's one big reason. I think this year we are obviously optimistic because we are sitting on, very low inventory in the network. Pent-up demand is still there. We have introduction of, a lot of models, from most of the OEMs, but nevertheless, I think currently the economy is getting into a kind of a cautious, stage. And, that is because, we see all the high frequency indicators, for example, the crude oil prices are very high. Exchange rate is really hitting hard the auto industry. And then, the biggest setback is the inflation is very high, which means that interest rates are going to be, really on the top, as we move into the 2023. So obviously, I think the party should be over by 2022, and 2023 as we enter with a lot of new challenges.
Srivastava added that the August sales trend indicated that while growth momentum was continuing in the SUV segment, it had plateaued for sedans.
In a mini, SUV also, we have a few options, then subcompact, then compact, then mid-size, so obviously all this is leading to a boom. So nevertheless, again, hatchbacks will be a very important segment in India always. So sedan, currently is losing the pace and is losing to obviously hatchbacks and SUVs. We may be seeing a few good, EV options in sedans, in coming years, which will again give a flip to the sedan segment.
Tata Motors saw its PV sales continue the strong run of the previous months with a 68.3% year-on-year jump in August. Mahindra & Mahindra saw continuing momentum thanks to new SUV launches, with sales advancing at a brisk pace of 87% over the corresponding month last year. The Scorpio N, Scorpio Classic and Bolero Max pickup models have been driving the volumes. Sales at Toyota Kirloskar Motor increased by 17.12% year-on-year in August. According to a company executive, the Innova Krista, Fortuner and Legender models witnessed unprecedented customer orders that month. The company recently said that it was putting a temporary freeze on orders for Innova Krista's diesel variant, as the demand for it was huge, leading to longer waiting periods. Struggling for years, two-wheeler sales also saw a year-on-year uptick in August, though it came on a low base. The increase came as companies dispatched higher numbers ahead of the festive season. In their case too, an easing in the chip shortage helped increase production. The good news in August comes after a long spell of difficulties for the industry. In 2017, things began getting hot under the collar for auto firms. For starters, growth was affected by the implementation of the Goods and Services Tax. Second, just before the COVID-19 pandemic struck, the industry was worried about the imposition of BS6 emission norms, which would mean increased prices for consumers and significant investments by firms in cleaner technology. The onset of the pandemic almost came as the last straw on the camel's back. Factories, showrooms, and supply chains were shut down overnight due to the lockdowns. Auto firms had to scramble to adapt and survive. It's been a long road to recovery. Given the role that pent-up demand has played in the August sales figure, the boom will end in some months, and experts project that the industry will feel the pinch next financial year. It remains to be seen whether fuel prices and inflation will ease sufficiently by then and provide some relief to the industry.
India's wealthiest and now the world's third richest person, Gautam Adani, has been in the fast lane for a while now. Apart from acquiring wealth, he's on a shopping spree too. But one of his recent and most debated takeover attempts seems to have run into rough weather. Adani's acquisition of NDTV may not be as easy as it appeared initially. Let us find out why.
In the past 2.5 years, the Adani Group has made about 30 acquisitions, shelling out over $20 billion. They have largely been a smooth affair. In the same period, Chairman Gautam Adani's net worth multiplied as the shares of his 7 listed group companies surged. Today, he is worth $141 billion and trails only Elon Musk and Jeff Bezos in the global rich list. Some of the group's big acquisitions in the last decade or so have been Abbott Point Coal Terminal in Australia in 2011, Dhamra Port in 2014, Mumbai Power Utility in 2017, GVK Airport Developers in 2020, Holcim's India Assets and DB Power in 2022, among others. Adani's biggest acquisition yet, Holcim's India Assets, Ambuja Cement and ACC, was announced on May 15th. The group's open offer was launched on August 26th. But Adani is facing resistance to its relatively smaller takeover bid for NDTV. In 2009, NDTV promoter company RRPR Holdings, owned by its founders Radhika and Pranoy Roy, took a 400 crore rupee loan from Vishwa Pradhan Commercial or VCPL and in exchange issued warrants that give the company a 99.99% stake in RRPR on conversion into shares. RRPR holds a 29.18% stake in NDTV. On August 23rd, Adani said it had acquired VCPL and exercised the rights, which NDTV said was done without its consent. NDTV said the Roys were prohibited from dealing in India's securities market until November this year due to a 2020 SEBI decision in a case of suspected insider trading, and therefore RRPR cannot convert the warrants it issued to VCPL. Although Adani said SEBI restrictions were not applicable on RRPR, both Adani and NDTV have now sought clarifications from the regulator. Last week, the promoter entity RRPR said it would require the Income Tax Department's approval to convert warrants into equity shares to now Adani-owned VCPL, as authorities attached its stake in NDTV as part of a reassessment of its taxes. Adani countered, saying the order applies only to shares of NDTV held by RRPR and in no manner restricts it from converting VCPL's warrants. It added that the Roys tried to further inordinately delay the deal.
Given that it is the entity that has to issue the shares, there is no real dealing of shares that is being done by either of the two promoters. So there should be no problem there. The second one is also a similar defense that is being taken by NDTV, which is that the two promoters are prohibited from selling shares under Section 281 because there must be certain income tax proceedings that are pending. But once again, the point here is that neither of the two of them are really personally involved in the sale of shares, right? So this is just being used as a tactic by NDTV to sort of slow down this process. But yes, there are certain other approvals that could also be required. For example, there would be a Ministry of Information and Broadcasting because of certain uplinking, downlinking guidelines. There's a TRI approval involved because this is clearly going to be a matter of change in control.
This can become painful for the Adanis if SEBI decides to either keep quiet and not do anything about it, or they take a view saying that, in favor of them or against them, because then what it would lead to is a situation where if they have taken a view, then they are also part of any kind of litigation that will happen, because the other side will surely take this to the next appellate authority or court. If they keep quiet about it, again, it could cause delays. If now SEBI does take another position, which could be a very sensible view for them, which is to say that we don't have jurisdiction, then it might smoothen things out, because then the only thing that will stop this transaction from moving forward is a stay that the Roys will have to get from a competent court, which doesn't get overturned immediately by the Adanis.
Ravikumar says the only way Roys can fend off the takeover attempt is to find a white knight, but that it is a tough task. Meanwhile, Adani's open offer for an additional 26% stake in NDTV is likely to open on October 17th. The response, however, could be tepid, since NDTV shares are trading at a 75% premium to the open offer price. While it is uncertain if SEBI and Income Tax Department will come back with a quick response, the Roys could have a surprise to throw. They can bring up a clause from the original loan agreement which states that VCPL and its affiliates cannot purchase shares of NDTV, which will increase their holding to more than 26% in the company without the consent of the other parties. One could argue that in the current transaction, Adani Group's acquisition of NDTV's stake is routed indirectly and would not violate the clause. It is not VCPL that is directly acquiring NDTV shares. The shares are still held by RRPR, but the conversion of warrants would give VCPL control of RRPR. Pioneer Legal's Pitaja says the clause would have to be read harmoniously with the rest of the provisions in the loan agreement. Given how the takeover bid is structured, legal experts believe that Adani would have both anticipated and prepared for this kind of pushback from the NDTV founders. But it could all come down to the interpretation of the agreement, making the acquisition process painful for the Adani Group.
Meanwhile, domestic equity markets underwent a roller coaster ride last week. Even though rate hike concerns dented sentiment, positive macro cues, strong foreign flows, and softened crude oil prices fueled hopes of moderation in inflationary pressures and supported investors' risk appetite. Our next report delves into key triggers likely to guide markets this week and levels to watch out for.
Volatility swept domestic markets last week, marred by declining global sentiments after the US Federal Reserve Chairman Jerome Powell propelled rate hike concerns on reiteration of hawkish stance. Yet, strong foreign inflows helped frontline indices end flat. The benchmark index Nifty 50, for instance, dipped a meager 0.1% last week, while the BSE Sensex fell 0.05%. While analysts attribute the Indian market's resilience to healthy foreign inflows, they fear the peak of FII buying may be over. According to VK Vijay Kumar of Geojit Financial Services, FIIs are increasing their short positions in derivatives amid a surging dollar index that hit a 20-year high of 109.6 last Thursday. This and the US 10-year bond yield racing to 3.26% is unfavorable for emerging market equities. Analysts at Credit Suisse too have downgraded equities to underweight on the back of rising inflation and recession fears. Going forward, analysts see markets to remain range-bound in the near term.
The market is currently eyeing the central bank's guidance on interest rate trajectory as the US Fed turned hawkish in Jackson Hole Symposium, which signaled that Fed will continue to raise the rate till the inflation decline into a comfortable zone. Based on this, the probability of 75 bips rate hike expectation in September 2022 meeting has risen sharply, making the direction of bond yield critical at this juncture. The macroeconomic development that follows after this meeting will continue to influence the market in near term, will limit the upside from the current levels. These macroeconomic developments include ongoing Russia-Ukraine conflict, trend of commodity prices including oil, direction of inflation, growth in developed world, and the bond yields. Keeping this development in view, we expect market performance to remain range-bound in the near term.
Apart from FII buying, falling crude oil prices also supported Indian equities last week. Brent crude prices have retreated below the $100 per barrel mark and may be heading towards $80 per barrel level, hopes Mohammad Imran of Sharekhan. He says, "We expect prices to fall further under $80 in coming weeks. Though a resilient labor market in the US may push crude to test resistance of $92, we remain bearish on crude oil outlook in near term." Against this backdrop, technical charts suggest that 50-pack index can move towards 17,850 levels this week, with a support of 17,350 on the downside. The S&P BSE Sensex, meanwhile, can steer towards 59,800 on the upside, with 58,000 acting as a strong support. Fundamentally, the European Central Bank's interest rate decision, rupee movement, and crude oil prices will guide markets during the week.
Financial markets are not the only victims of global upheaval. Several countries are teetering on the edge of recession due to it. India has extended the duration of the $400 million currency swap facility given to Sri Lanka, which is in dire straits. But what exactly is currency swap? Our next report offers an insight.
In its bid to help the developing countries, the Indian government may soon allow currency swaps backed by mineral resources. A currency swap is an agreement between two cross-border entities where one of them agrees to provide a loan to another in a foreign currency. The repayment takes place in a different currency at a fixed date and an exchange rate. The interest rate charged on such loans is usually lesser than that available in the foreign market. Let's understand it with an example. Suppose India signs a currency swap agreement worth $5 million with, say, Nepal. India will then provide a loan to Nepal in a foreign currency, which may be US dollar. In return, Nepal will have to return the money in Indian rupees at a fixed interest rate. This comes as a savior for the countries going through a foreign reserve crisis, as it allows them to get a loan in USD at a lower rate of interest. Sri Lanka has been going through severe economic and political turmoil for the last several months now. High inflation and depletion of foreign reserves to an unsustainable level led the country to utter chaos. To help the neighbor, India signed a currency swap agreement of $400 million with Sri Lanka, and in April extended its term for repayment after the country said that it cannot meet its debt obligations. Since 2018, India has agreed to sign currency swaps with 23 countries. These swaps allow the countries to get a loan at a lower rate of interest than the foreign markets. Also, it helps the recipient country to maintain their foreign reserves even as other foreign debt obligations loom large. The exchange rates of currencies keep changing every day. This may lead to inconvenience at the time of repayment. For this, the exchange rate is usually fixed in advance during the signing of the agreement. So, the repayment amount remains largely the same. With the government mulling over backing the currency swaps with trade, we may see India extending more such agreements to developing countries.
I will achieve, I will fly high, in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
An IMF paper had said last year that China has started to expand its currency swap network in a bid to promote internationalization of the renminbi. That is all for today. We'll be back tomorrow with more news and analysis. Thank you for watching.
For more news, views and updates, subscribe to Business Standard on Google Podcast, Apple Podcast and Spotify. Also follow us on YouTube, Vimeo, Instagram, Twitter, Facebook and LinkedIn.